then into the rest of the week. One of the really amazing things that has happened here over this last 24 hours is that the Bank of Japan hiked interest rates to 1%. And that is the highest rate, overnight rate for the Bank of Japan in 31 years. And one of the fascinating part about this is that in the prediction error, one of the most well-known relationships inside of the broad kind of macro investing world is that when a central bank hikes an overnight rate, that it should increase the value of the currency. The Bank of Japan and their Treasury Department just recently spent 10 trillion yen in supporting the currency. They're hiking interest rates to the 31-year high. They are putting forward very hawkish statements and trying to support the value of the yen, and the yen keeps on weakening. It keeps on weakening to the U.S. dollar, and this kind of prediction error is fascinating in that there's a group of individuals who, and rightly so, have this. We have this environment here where there's a possibility for a yen carry trade unwind. But the same environment that creates the yen carry trade unwind creates the yen carry trade wind up. And I'm going to explain that. The ingredients to bake the cake, so to speak, of the yen carry trade unwind is first a negative correlation in the broad markets. And we're getting that. We have that on the 15-day period. We're getting it on the 30-day. So first ingredient, check. The second ingredient is you have a strengthening U.S. dollar. You have a strengthening U.S. dollar. Now, over the longer term time frame, you can see we have monthly longs, we have weekly double bottoms, we have daily longs, and we're pulling back into a support level here from our May lows to highs. But in the intraday time frame, there is a dollar weakness trade that's going on. And so while you have that negative correlation and then you have yen weakness, you also have dollar weakness. And so it actually looks like a yen carry trade wind up inside of, as in the markets are getting more leveraged. They're putting on new positions. They're borrowing more yen. Why is that? Well, is the spread still there? I mean, technically, yes, they have hiked interest rates, but the spread still has room in it from the perspective of profit potential. As long as the yen is weakening, there's no issue. As long as the dollar is weakening, there's no issue, right? It's when you have three things that really start to change. If you have a strengthening dollar, start to change that formula. If you have a yen strength trade that starts to develop, or you have an environment where the Federal Reserve is perceived as being maybe more dovish than they were anticipated to be, then if any one of those three things happen, then we start knocking over dominoes and we go from yen carry trade wind up to yen carry trade unwind. And it is a phenomenon here that we're going to be monitoring in real time and looking at how it develops here over the next coming days. So here's the dollar weakness trade, DXY falling back down into its daily long setup. And you can easily imagine an environment here where the dollar is weakening into these Wednesday support levels. This stream continues at emoneyaddict.com. The link is in the description. Join me there for tools and resources for learning measured move trading. I wrote the book on the measured move. Check out the hundreds of others that have learned trading plan development, pattern recognition, money management, and trading discipline with me to become the best, most confident trader that you can be.